property with Rethink Investing.
Australia's largest and most comprehensive podcast covering all things commercial investing.
G'day, how you going? Phil Tarrant. Welcome to Inside Commercial Property, episode 53 with Scott O'Neill, Rethink Investing. Scott, how you going? You well?
Very good, mate. Very good. How are you?
I'm right. I'm uncomfortable. I don't like recording a podcast without headphones on.
I know.
There's too much ambient noise. It does. You know, it's. But I'm okay with change.
Yeah. It came out well last time. So.
Yeah, it did. Yeah. Well, we're recording today. The Reserve Bank of Australia is about to hand down its interest rate announcement.
Yep. Nothing's
going to change.
No, market's pricing in a hold till Feb 25 until the next data set comes out. But looks interesting because they had the big cut in by the Fed, 50 basis points. So one would think now the trend is well and truly down globally. So Australia normally follows suit 6 months after the US, and NZ's had their cut. They're going to have another couple coming up, they reckon. And Australia's the one lagging at the moment. So it's good as a buyer's agent, I think, because it gives us an opportunity to buy well for a longer period of time. Because if the rate cut happened now, I think we're just going to run into more competition and prices go up. And as a buyer's agent, you want to get it at the best possible price rather than into a market that's already gone. Yeah.
Well, a lot of people sort of confuse what's going on in America with what's going on in Australia. I think including our Prime Minister who thought the reason why the US was cutting rates because its economy was in the doldrums, but it's performing a lot better than ours here with subdued GDP growth. And a lot of this is connecting with business and how business is an enabler and connected with the economy. We spoke when we launched this podcast, we're 53 episodes in through COVID, that commercial property is an aspect of the Australian economy. Its fortunes are largely linked with how well the Australian economy is performing, and every single commercial premises that an investor invests in is connected in with some sort of business activity. So if business is up, commercial property is normally okay. If business is down, it has ramification impact. But for a lot of people, that's probably the best time to buy.
Oh, exactly. And we're seeing a lot change. Like even the famous, fragile office market, it looks like it's bottoming out in many areas. There's a whole host of new AFR articles out there saying there's companies mandating back to work, and that's happening all over the world at the moment. Yeah. So the fact the office market's bottoming out in many areas is a good sign the economy is basically turning. Yeah,
we saw was it Amazon just this week said they're mandating everyone back in the office 5 days a week. They're at 3 days a week. We see a lot of the state governments are mandating return to work here in New South Wales in particular, and that's sort of copped some backlash. But I think it's on the right trajectory. I still think there's to be flexibility in the workplace. Let's not forget some of the things that we learned through COVID. But people back into the offices, I think, is good for productivity. It's good for business. It's good for connectivity. I think people are happier when they're with humans rather than stuck in a flat somewhere with a cat. It's sometimes not the most productive thing to do.
No, you're right. And there's almost two cultures. Like the guys that work 100% out of the office, they're siloed in their thoughts, and it can. There's just different cultures. There's the office people, and then the ones that sort of never see the office, and they're just sort of slightly off the page and running at on their own rhythm, which doesn't match with the company a lot of the time. But you're right. People generally like working with others. It's not fun being in isolation all the time, but the flexible work arrangement, that's my belief, is the best case, because that's what I like. I don't want to be in the office 5 days a week, but if it was the option to have 2 days at home, like you can catch up on things that, like phone calls, like rather than just sitting in a cubicle, you can just do it walking around the street. There's that brings enjoyment and just breaks up the day. Time flies faster when you're not doing the same thing all the time.
It certainly does. So what does all this have to do with commercial property? Well, quite a lot, because the way in which Australia or people work will determine the drivers and the sentiments towards certain businesses, and therefore there's ramifications of that with what sort of commercial property is going to perform the best. Now, to that I would say if less people are at home sitting around waiting for their online shopping to arrive and they're in the office, does that mean there's going to be a detrimental impact on warehouses and logistics type commercial assets with more people back into the office and actually going out at lunchtime and buying their stuff? Yeah. Should you really dig too deep into this, or it's just going to be one of those things, there's such momentum now with the changing economics of e-commerce that industrial spaces will stay the same?
Yeah, look, it's a good question. Like, we were going through the due diligence on a shopping centre that was located in an industrial area, and we're just thinking about all the different, I guess, impacts the last 5 years have had when people started working from home. And our conclusion was that factory workers were always sort of going to work, and that's why that particular centre was thriving. And we'll think of what if things change. It's not going to change for the worse, I don't think. So a lot of these shopping centres were built around like housing estates and stuff like that. So, if less people are going to work, that'll help. But if more people are working, earning more better money and coming home, like they're still living around these areas. There's just the CBD factor's the big one that will change, because that one died off. And, if you're owning a little cafe and you needed that morning traffic, and then 60% of workers aren't in the city anymore, then that'll kill your business. Rents will suffer as a result. But there is a reversal effect happening. And like you said, governments are changing. I think Tabcorp announced full-time like a couple of days ago. Like, all these businesses, one by one, are just starting to go back to where they were. And it's for productivity, because, it's really individual-based. Some individuals work incredibly well alone. And there's others that, we'll treat it like a bit of a holiday. We all know that. It's just, if you love your job, you'll do more than if you don't. If I worked for some company that I didn't want to be there, of course you're going to do a little bit less. And if no one's watching,
there's always people out there bludgeon.
Yeah,
it's the way it is. But particularly as we come into the summer and it gets warmer outside and the beach is attractive.
Look, the beaches are like, I was at Bondi like midday yesterday, and it looked like a Sunday. It was. And they're all full of like middle-aged people. Like, they're not working. Like, they're having a good time.
Well, these are the intricacies of asset selection when it comes to commercial property and just how it's connected in with the economy. But outside of the scope of today's podcast, what I'm interested to chat to you about, and I've often thought about this, to try and get a sense for the client base that you have within Rethink, and I've met some of them. We had a well-regarded soccer player on the last time we got together, and I got to know him sort of at one of your functions. He was a really good guy. So you have these sort of elite athletes who probably make a few bucks.
Yep.
But I would imagine, and I'm just guessing here out loud, that you would have a lot of business owners in your cohort of investors who are probably at the point where they're deploying their dough into assets outside of their business, having made their money in property. There's this old monk here of make your money in business and park it in property. You flick through any of the BRW sort of rich lists and stuff, it would say that they're in mining, pharmaceuticals, something, and also property. And everyone's also property. And it sounds as though that's a common navigation for most people, is to go and make their dough somewhere and park it in property. And that's a process I'm on. I was business first and property second. But you're the reverse of that, aren't you? You're like property first and then you turn into a business.
Yeah, and this is why I like this question, because we're the opposite here. I was an engineer, quite a conservative investor. Like, I struggled to make money and I needed to preserve it. So I was building it on the side of the business as long as I could. And I would have never started, this is just me, never started a business without a portfolio, because I just wouldn't have had the financial confidence to do it. Like, I had the golden handcuffs with a career that was, somewhat recession-proof, because, engineers, they either do government jobs or private jobs.
Just hypothetically, if you were still an engineer, how much would you be earning a year?
Oh, look,
you're probably pretty senior, I'd imagine.
Look, you can make, I was, like, I saw tables I shouldn't have seen when they let the HR file open, and I clicked in as a junior grad, and I saw what everyone was getting paid. And this is back 10, 15 years ago now. And project managers at the time were, that's sort of someone with 5 years job, you get like 140, that type of thing. And then it was kind of like 20 grand extra every year. But let's say you're a construction manager of a project, you can be in the 300s. If you're like a regional manager, you're into the 500s. And, my goal was to keep going. So I was doing an MBA I wanted to be up there at the top. That was the goal, because I just thought that's what I grew up learning. Like, my father was a career guy, I guess, so that's all we ever knew. He did a little bit of property stuff on the side, but that was the way to get more money, get promotions. And business never came into my mindset. I just was like, my mind of a business, which was ignorant at the time, is like, what, I'm going to go be a cafe owner, or a restaurant or, that kind of thing. Or I did actually see my father purchase he had a midlife crisis where he just got out of his career and bought a bathroom supply franchise, and it blew up. It did terribly. So that was like, I don't want to go near that stuff. So because of those types of things, I just saw many reasons not to go into small business. But the way out of it was earn good money and then deploy that money so I could turn $1 into $2 and just repeat that process. And that's where the high cash flow portfolio strategy was good. And I understand compound growth and how to understand money in future senses, and leveraging was the key. And I'd use my salary just to do that. And if the goal was to bring retirement 10 years earlier. So I didn't have these big dreams to, cheat the system. I was literally like, I just want to bring it 10 years earlier so I can retire at 50, because 50 is still pretty young to have options not to work. And that's where I went property first.
Yeah. So
but
property
you went the
first.
other way.
I went the other way. I didn't have any money. I was, I didn't have a fancy job like you where you made good dough. I was just, a struggling student, really, just trying to get ahead. But the only utility I had was to try and make some dough in business. So I went business, but I didn't enter into business on the basis that I would end up buying a lot of property. It didn't even come into mind.
So how did you actually get started in business? Because that's a big step. Like you don't just open an ABN and
pretty much that's all I did, right? Like I guess this was about 17, 18 years ago. I just did what people still do now. I created a side hustle that turned into something, right? Okay. So I was a journo working at a company, and people just going, "Oh, do you know someone who can write this for me, or do you know someone who can write that for me?" So I just started doing that as a side hustle with my now business partner, Alex, and that got to a point where I went, "Oh, hang on a second, like I could probably do this full time," and left employment, started the company, just knocking out articles for people, and that turned into a communications company, which ended up winning a whole bunch of work with very large financial companies.
So you were profiting from day one.
Yeah.
Okay.
But paid myself a salary from the first day.
Yep.
Wasn't very large. Never had any debt. Never had any seed capital. Never had anything. Everything was built off our balance sheet, and still is to today. We're quite prolific investors these days in other organisations, and we finance everything. We fund everything off our own balance sheet, which is a really strong position. Yep. But it's really easy. A lot of people get obsessed with business thinking, "Oh, I've got to do this. Mate, it's really, really simple business. Just make more money than you spend." Yep. So try and be profitable from day one. And most people see the world very differently these days. They get obsessed with what they see on social media. People out there raising money. I've raised this in a Series A round or a seed round or whatever. And people get obsessed, and they think business is how well you can get people to invest in you so you can burn money so you get another round of investment.
I've never
hopefully increase your valuation. That's that's a new way. The best way is old-fashioned, and it's back that way these days because you don't see a lot of people throwing around dough these days on harebrained ideas thinking they're going to get a huge valuation.
No. Or you remember like the milk run days. Like that was sort of that period after COVID where money was getting splashed everywhere and there's hyper valuations on companies that didn't make money. And they weren't going to make money for decades too. And again, this is my old school. I'm with you. If you're not making profit day one, it's too risky.
So why would you do
doing
it?
it to sell out.
Yeah.
And that's, I don't know, that's just a short way of running a business as well. Like it's like if you're that passionate about a business that you need to just sell it to get your money, then you're just doing it for the cash. And that's generally not a good way of running a business.
Well, you're not probably creating long-term value for your customers or your clients, whoever it is, right? And look, to be fair, there's a lot of people that do it really, really well, and that's how they go about doing it, and that's fine. But more often than not, it doesn't work.
Correct.
If you want to build a business and you choose to do it the old-fashioned way, the likelihood of success is probably a lot higher. Yeah. You need to remember, 1 in 2 small businesses still fail. I can't remember in like 2 or 3 years. The reason why is that most people, and this is going to be, this is quite a topical comment, most people shouldn't be in business for themselves. Yeah. The likelihood of success is low. And that sounds horrible, and a lot of people don't want to hear that. But I saw some numbers the other day saying that, what's the new generation? Generation Z, is it? Or generation, not millennials, but the one after them. More than half of them want to be in business for themselves, because they don't want to dial into this notion of a 9 to 5, which is, in their view, sort of an old-fashioned view. Maybe it is, but there's a good chance that most of those people who actually go into business for themselves will fail.
Yeah,
that sounds horrible.
Well, I've got a mate who works in San Francisco for one of the big private equity firms, and they're the types that would put money on all those, the Ubers of the world.
Yeah,
and their mantra is they expect 9 out of 10 to fail.
Yep.
So they'll put a lot of money in it, but 1 out of 10 is 50x.
Yeah.
And that's how they make their money. That's their entire business model, investing hundreds of millions of US dollars in companies that they know will fail. But just because one goes bonkers, then that's
compensates for everything else.
That's how they make their good returns.
Yeah. And if you've got all that dough to spend and that's your mandate, that's fine. And I'd say that's quite intelligent, smart, very considered. But most people haven't got the smarts or sophistication to be able to do that.
High risk, high reward.
So if you're going to go into business, do it the old-fashioned way. Make a profit from day one, which can be difficult, right? And if you're doing, it's probably easier these days, but also harder at the same time because, 50 years ago, there was probably a lot more capital expenses that need to go into creating a business. You couldn't just swap your time and smarts for money, right? Which is more of a service-based business. But these days, and like Rethink, right? You're a people company.
Yeah.
I know you buy like $100 laptops for your staff, but you keep it pretty lean. But your business is the people, and how connected, engaged, and capable they are. And
I think there's a gap in the market where like that my old school way of climb the corporate ladder. There's less people that want to do that now, and but you need the experience, and you need to have that ability to think like a business owner to kind of add value to those big companies. Because again, like, I get to see a lot of successful people invest, and most of them are, those kind of executives in big companies, doctors, sports people, and then you get the business owners. But the ones that are successful in business run, these are just my client base, good, sturdy busises that everyone knows.
They're probably boring businesses.
Yeah, like mechanics that they might have a chain of them, or, there's even like people like George Gregan, he's got a chain of cafes around. But you just find one thing you're good at. Generally, it's, it might be running a billboard company type of thing. But these kind of IT businesses are very hit and miss. But I do have a few of those. But they're guys that are found a niche, but that's more of you don't turn a profit. You're there for the sellout, and you've got to bootstrap it until you sell it. So you kind of live quite frugally.
Do you have any OnlyFans creators in your?
Not yet.
Not yet. See, this I saw a thing to pay the other day. It's like, but most of the successful people who are successful property investors who are often in business, you would never have heard about their business. It'd be a business which wouldn't hit the radar on a social media feed about, hey, look how cool and exciting and purpose-driven this business is. And a lot of people's frame of reference on what their future looks like if they want to go into business is what they see on social media. Most of the things you see on social media is people selling courses on how you can create a course to be successful.
Business coaches, lifestyle, health is the
other
other
lot of
one.
it is a massive myth, right, that people subscribing into. So if you want to be successful in business, choose a business. Like they reckon one of the most successful businesses is like a laundromat, stuff like this. Businesses which people overlook, which are largely analog, are the ones which continue to deliver and prosper. And you must see in your client base.
Yeah. Well, I've got a client that has set up a number of those, and he has this like app which just sort of shows exactly how much money they're all ticking over, and he's getting a 30% return. So you got to come up with a capital. Yeah. And I was like, wow, 30%. Like you should just buy a shopping centre and then put a couple in your own shopping centre, and then you run. I was sort of almost saying there might be a strategy where you can buy vacant retail for a discounted rate, whack your business in there, put a 10-year lease on it, sell it. It's almost like what KFC would do on a more micro level, and because the lease will add value to the property. So you're not just making money through the business, you're making it through, basically leveraging off the new cap rate you've created in that market with the sturdy tenant.
So make your money business, parking and property?
Yeah, well, that's what you did. So,
well, parking. I haven't parked it yet. Well, still in the process of parking.
Like, for example, because obviously I've spoken to you for many years, like it's about preserving your wealth outside of your business. You don't need your portfolio to save you at the end of the day. You'll work as long as you want to work. But it's just nice to have a nest egg that's just cooking in the background. It's got nothing to do with your current state of affairs. And if all blows up with work, or, you something happens, you've just got that nest egg settled. And that's what most people do. They save their way, build it.
Yeah.
And the portfolio will give you confidence to do other things, because I've never met an investor that, under the age of 50, that doesn't work.
Yeah.
Like they have passion projects. Like an extreme example is one of my earlier clients. He built a big, large portfolio. He then sold everything, moved to Spain. He lives in Spain now, and he's trying to create a drone league racing thing. So he's traveling around the world trying to drum up.
Sounds like a nice life he's created himself.
Yeah, like he's just passionate about flying vehicles, and that's what he wants to kind of monetize now.
And you go back to this idea of the rich list in Australia, right? They're all in business somewhere, and they also have real estate assets. Like not the young rich, but the rich.
Yeah.
They're not relatively young people. Most of them are older, in their 60s, 70s, and 80s, right?
Yeah.
An interesting point around successful people I see, particularly those in business, is that they might start down that pathway going, oh, look, I want to make sure I'm comfortable in whatever retirement looks like for them. But when they get to 50 or get to 60, the things that make them so successful to be successful at that point in time means that they'll never stop.
Yeah.
You never really see highly successful retired people. They're always doing something. Now, their life might look differently than what it did 20 or 30 years ago, and they might not be as operational as what they used to be, but they're still involved, they're still engaged, they're still connected, they're still invested, they still go to the office every day, but they've created a business lifestyle which suits what makes them successful, right? And there's nothing wrong with that. There's still a lot of people racing towards retirement. When they get there, they're disappointed.
Yeah, well, it's how long can you do nothing for? And I listened to a good podcast, like it was Arthur Laundrie, the publican.
Yeah.
So I think he's in his 80s or nearly 90s, and he's telling stories how he still goes around to his pubs like cleaning up, and all the staff get embarrassed going, oh, don't do that. But he loves the customer service.
Yeah.
He's got his family working within the business, like second generation. And he said he'll do it to his dead, basically, because he's creating a legacy for his family. Like it's all for them, but they've got to learn about it. And I guess you feel like you're contributing. And, like all billionaires, well, I don't know if he's a billionaire or not, but like they say, oh, money doesn't matter. Of course it doesn't to them. But there's a comfortability knowing that it's protected that would make him feel really good when he goes to bed at night. And then he's still adding value to society instead of sitting around doing what, lawn bowls? What would a guy do at that age?
And you speak to any doctor, they reckon as soon as you stop using the grey matter upstairs is when things start slowing down. So use it or you lose it. But the point is it's deploying the utility of the money you're creating today to create a better tomorrow. Whatever your better tomorrow looks like, that's completely individual to every single person. No doubt most of the people tuning to this podcast are on a pathway somewhere of creating a better tomorrow. They might not necessarily know what it is. I don't know what it is still, but I just know it's the right thing to do. But, it's a double-edged sword, as a dichotomy with this business of property thing, because if you're so immersed inside your business, you often don't give the property enough oversight and it becomes too passive. Yeah. And I think about myself investing in property. I've been investing for a decade or so. Like my portfolio could be 3-4 times bigger than what it is, right? And it's not purely because I've compromised the focus and energy and effort on that whilst I've gone away and created value elsewhere, which is okay and you can always come back to it, but time starts ticking, right? So you've got to actually give it the love and the attention it needs on the way through without it being too passive. And we have a portfolio. We speak about it publicly. It's just one of a number of ways we invest, but we created a portfolio for smart property investment, which a lot of people might be know of by tuning into this podcast as part of smartpropertyinvestment.com.au. And we went, we're going to create a portfolio. It's like a decade or so ago because there's so much BS out there going like all you heard and saw were the success stories of people investing in property. You never saw the realities of it. Let's remember, was it so most property investors own between 1 or 2 residential properties, right? There's only a handful of a fraction to get to 5 and 6 and into 10 and 20, right? Yeah. It's a minority. There's literally, you could count them in hundreds, I think, people that owns like huge multiple portfolios. So, you've got to give a sense that when you immerse yourself in property podcasts, you think everyone's got huge portfolios. No, most investors still only have, if they're on the sophisticated side, you've got 6, right? So, if you've got over 6 properties, you're in a very small cohort of people. But we built this out on the basis of what is it really like to actually build a portfolio. And we built the smart property investment. I guess most people probably think it's big. I sort of see it as quite small. We built that out to be worth, I can't remember exactly the number, maybe $12 million or something or other in resi assets. It had about 17 properties in it. We sold off a whole bunch recently. So we're left with a portfolio now with about $6 million in value, and it's about 50% LVR on it, right? Okay.
And how still, can you sold so many down out of interest?
Just to deploy the dough elsewhere.
Yeah.
And they're all properties in the western suburbs of Sydney, which had all some of them nearly tripled in value.
Felt like you got the
we got the upside on it, take the win and deployed it elsewhere.
Yeah. Was it to solve any cash flow issues as well? So the portfolio was pretty stable.
The portfolio was negative.
Yeah.
It's negative because when you've got, resi properties, right? Like, it's a huge myth that you can have a positively geared residential portfolio that's big quickly. Yeah. It's one of the biggest myths in property, and it really concerns me. There's a lot of people out there peddling this idea of creating big, passively geared residential properties. I think it's very hard in this market if you're just starting out.
Yeah. No, look, we've called it out a couple of times on this podcast, but there's it's a big risk. Like it's like obviously we're in an industry which doesn't have much regulation, so you could say whatever you want.
Yeah.
And there's guys out there say, I got 50, 100 houses. Like if you've got 100 houses and they're sitting at 4 or 5% gross yields, you take the real cost out of that, you're sitting at 3% net.
Yeah.
Like I actually wish the whole industry would stop quoting gross yields. Yeah. It's just a joke. Like you're missing half the equation. So it's not 5% gross, it's 3% net. What's 3% net going to get you in this market? Nothing, because your interest rates are 6%. Yeah. You're using debt, recycling debt, so it's highly leveraged. And then let's be honest, you've got to then start fixing these places up. And that maintenance bill that you probably allowed for $1,000 a year in your spreadsheet, it could be $5,000 a year. It's a seriously highly negatively geared strategy, and it won't take much to unravel that if there is changes in business confidence and lending and things like that.
And this comes back to the point around building a portfolio passively but sort of connectedly. That portfolio now, it's got about $3 and a bit million worth of debt in it, which is, it's not that much, right? But it's still negatively geared, that portfolio, to the tune of about 50 or 60 grand, right? And it's purely because it all sits in trust. You're paying land tax and everything. Like, it's how you construct your portfolio. It's got to really influence its cash position. So,
Well, land tax is the big change in the last few years. Like that's one of the reasons Melbourne's
tanking.
Certain issues. Like I know personally, if I buy a property in New South Wales, like if it's a few $1 million, I can be up for tens of thousands of dollars for just land tax alone. So I'd
hate to know your land tax bill, mate.
Well, it's not too bad because I've spread it out day one really carefully between all the states. So I'm quite spread out, and I've used every threshold I can, and it does make a difference because if you're like one of the old school investors who just bought 6 properties in New South Wales, well, a lot of the Victorians, because they used to love only investing in Victoria back in the early 2015, 16s era, their land tax is just
crazy.
It destroyed the entire strategy. And it's a political risk, as we said. Like there's no reason why state governments will not make it even worse, because as more people become non-property owners, there's going to be a greater voter base that wants property owners to be hurt.
Yeah.
And that's you just got to keep in mind this type of stuff and buy properties that spread them out. That's why I like commercial, because you have leases where, or often you have leases where there's the tenant has to pay land tax, and you just got to manage the risk, and that's super important.
And again, there's going to be particular times in your business career if you choose to deploy your dough into property when certain properties are going to be more attractive than other properties, right? And every portfolio has a cycle. Like this portfolio, when we started with 200 grand, right, in cash. It grew out to whatever it was, 12 odd million bucks. It was a really good portfolio, like huge amount of capital growth in it.
Especially when the interest rates were lower too.
Interest rate. Well, we went through, we held high-ish interest rates for all the period, right, from like 2012 or 13, it was up to 5.5%, 6% sometimes in trusts as investors. Obviously they had to fight hard to get them down during those sort of COVID periods, but we fixed the period at certain periods and at the wrong time, and so it's always been a negative portfolio. Some years, you're talking. Six figures negative, where a lot of people think, how do you it's okay, we can sort it out. It's a big portfolio, right? Huge amount of capital growth in it, right? Yep. Which so for the purpose of what this thing was for is that to create capital growth, and we took the 200 grand back out of it, so it never owed us a cent, right? It was just like a free portfolio, really, other than time, energy, and effort to do it, and the graph. Like we built this through a really good buyer's agent, you know who that is, and who I still have a relationship with today. It's really downsized now. We've got rid of a lot of all the Sydney assets, or some of them. So I'm sitting at about sort of $6 million in value, but I still look at the negative cash flow at 50, call it 60 grand. It's time to chuck a commercial asset in there. Would be the next step for this, right? As part of its pathway. And this is supposed to be an educational tool. If people want to check this out, then go to smartpropertyinvestment.com.au. If I can do a plug on this podcast for that. It's done well, but I'd like to calibrate its cash position. That said, though, because it's been operating in a negative position, if you've got a good accountant, when you do offload or sell down assets, there is benefits to have that negative position inside a trust for capital gains tax. So, you've got to be super strategic with it all.
That's right. And look, we spoke offline about your portfolio, and you're right, like commercial is the next. Like it's you're a fairly typical type of client would come across where you've done a lot of investing, the strategy's done well.
Would that be a small portfolio for your average client, or would that be like a bit pretty average? It'd
be still top 30%.
Okay.
I'd say. So
and this is you got to put things in perspective sometimes. I look at that and just go, it's just a portfolio we use for an example to talk about investing in property. But for a lot of people, that would be a really attractive portfolio, which would set themselves up for a comfortable future.
And everyone has different lifestyles. Like you buy all the big fancy houses and stuff like that, and run many businesses. But many people don't need that. You might have a paid off house in the suburbs, and that's you need a lot less. Like if you've got a portfolio spitting out 200 grand a year, then most people could live on that forever, very comfortably. And there's all sorts of people doing that overseas, living off far less. In places like Bali and Thailand, and there's all that kind of lifestyle.
Well, you think about this, right? Like this generates about this portfolio generates. Let's have a quick look. About 300 grand in gross rent a year. You deduct out sort of 5% on that for other things. Call it $250,000 unencumbered. If you remove $3 million of debt in that, you live pretty well on that.
100%. Yeah. But I think if you got say 500 grand cash, my strategy for your property portfolio would be you just leverage that up to say 70%, so that'll give you about a 1.4 mil purchase. So you're going to be getting 100 grand net. So the tenant pays all your outgoings. Remember, maintenance, land tax, management, it will be covered. That's a 7% net yielding asset on just over 1.4 mil. But then you've got to take the mortgage out. So the current interest rates, you can get them into the low sixes. So let's say you use a 6.25%. So you've got to minus that off the 100. You're left with that 37K, 37,500. That's straight up clear income. So if you bought two of those, your portfolio's in the plus. And they're growing, and you've got diversity.
So you need $1 million. So turn that portfolio on that example. Positive, you need $1 million.
You injected
based on
current
current interest rates
into that deal. You're positively good.
Then
you haven't sold anything because you don't probably want to sell more. Like the higher the asset base you can hold for a longer period of time, the more money you'll make. That's the beauty of Australia.
But that's really only servicing the interest-only mortgages connected with it, right? You actually need to start hitting the principal if you really wanted that to be. But
look, principal's not a cost. That's a cash flow issue. Your interest is a cost. So I look at principal as you can always refinance and back into interest-only loans. There's always a bank that wants a healthy portfolio under their management. So, you can just delay the principal until it makes sense for when you can pay it. Because you can always sell properties too. Like that's a way of paying principal off. If, if you've got a 70% debt day one and you just don't do anything, paying no principal for 20 years,
and when I sort of start getting annoyed with property, I often feel that way. I don't want to talk about it. I don't want to hear about it. I'm just sick of it. I'll sit there and I'll just say that portfolio, you plug it into a capital growth calculator, in 10 years' time, that'll be worth 10, 12 million bucks, right?
And your LVR is lower.
And your LVR, if you're still carrying $3 million worth of debt, at that point in time, you probably only need to sell one asset and you're debt-free.
That's what I say to everyone, because they really get concerned about when I'm going to pay the debt off. Like, the more inflation you get for a longer period of time, your debt is fixed at a point in time. It's just going to become irrelevant at some point. Well, not irrelevant, but it'll become insignificant. So, like you said, your $3 million of debt, if your portfolio is worth 15, you don't care about that 3 mil. It sounds small. It's like the guy that bought the house 40 years ago when he maxed out, and you've just kind of kept it going for 40 years, and asset values have quadrupled. And that is, time will erode the debt. That's the fact of it.
Yeah, the idea is, though, you don't want it costing you too much to hold that debt for the period of time that you get into capital growth. And that's property investment. That's cash flow. And that, for many people, may be injecting a commercial property, because we've spoken about it before. Most people start down a pathway of resi property. They probably build a portfolio like that. Then they start going, I don't want to carry that negative cash flow more, because I want to be unencumbered potentially from having to contribute to a negative cash position. So that's when they pivot into commercial. But I know in your business, as awareness of what you do expands and more people listen to this podcast, you're getting a lot of like athletes and high performing sort of sports people knocking on your doors who are probably at a moment in time where they've got a decade of making good dough, and they're thinking, rather than going down this traditional pathway of resi into commercial, that they just go, I got this dough, I could probably preserve this much every single year. How do you get it to a point where I actually, same thing, make my money in business and park it in property? Their business is on a sports field, and it's probably finite, their ability to make that good dough. You can actually be a true accelerator in supporting that. We spoke about this with our previous guests. Is that something that's becoming popular, commercial first for sports players and sports people?
Yeah, and like it's always about creating like a passive income. Like 200 grand is the number that comes up the most at the moment. So
where does that number come from? Who's going, I want a couple hundred grand?
I think it's what so look, the average income of NRL players is around sort of 340, 360.
Is that the average, is it?
AFL's around 400 plus, just over. So, they expect there's going to be a drop in income, but they don't want to go back to 100K. Like, so 200 grand is obviously the number that works for most. I don't know why that was my number back in the day too. Like, I never, you hear people say I want $500,000 million passive income now, and a lot of that is a pipe dream. They don't understand the true asset base.
Do you know many people on $1 million passive income?
No.
That happens?
No, because they have other debts that basically smash that income. Like, you have one house in eastern suburbs of Sydney, that can be a $600,000 debt per annum.
Per annum.
Yeah. So
just to service it.
Exactly. So it depends on what you do outside of it. If you rent and got all your money in a portfolio, of course you can push the buck there. But it just so happens most people don't do that.
No.
They get tempted to buy the fancy cars or the holidays. You don't go, do a budget holiday in Fiji every year. They'll do Europe. And
so most people, I can't remember. There's a principle for it. You always orientate your lifestyle to the amount of money that you have. So no one's really ever got any money.
Keeping up with the Joneses.
Anyway. So sports people, so they can actually strategically and then tactically create a $200,000 passive income.
So to run through a plan, like we might have to. I've got a little table. We'll refer back.
Maybe we can do some
YouTube.
when the crew do the production on this. They can maybe do some overlays on tables and stuff, because I know it's hard to talk about numbers.
Exactly. So you might have to play this twice on the podcast to listen to it, but otherwise, we'll go onto YouTube and put some overlays on it. But this particular guy was he was one of the better players, like making about 750, 800 a K. So.
Would people know who this guy is? Like,
keep it's just like a standard senior player in whether it's AFL and NRL.
Footy,
and this 200 grand plan, like everyone's going to go, 750K, that's a lot. So just halve those numbers for your own sense. So you can say, this is what I could achieve, or, it's the same ratio. But he had 500 grand cash to use. And this is sort of similar numbers. What
Saved
I was just
it up.
talking. Yep. So 500 grand, we said, look, he had a few residential properties, time to fix your income. So 500 grand, leverage that up 70%. That's going to give you a $1.428 million purchase. He had $1 million loan on it, so the rest of the money went into stamp duty and other purchasing costs. The net income from that property was $100K after land tax, after management, after rates, insurance. So it was a true 7% net. And then he had his mortgage, which was $62K, so that left with that $37,500K number I was kind of talking about your portfolio for. Now, the plan was, he worked out he could save 300 grand cash each year. So this is not a plan of maximizing debt or refinancing. This is just clean, put 300 grand into the property every year. So we decided the best strategy would be to purchase every second year.
Sorry, just that point, this goes back to this sort of analog of running a traditional business where you actually not always out there trying to secure finance or raising capital so you can get more injection to keep going, about making profit. It's the same logic inside of, rather than, because again, if you listen to all the social media feeds, it's all about grow and extract equity, grow and extract equity, grow and extract equity. This is the old-fashioned way of like actually saving your dough and deploying it properly.
It's slower, more conservative, and I know it works.
Yeah.
So it's
probably a lot more predictable as well.
It's very predictable. You could do a lot more if you wanted to, but this, as you'll see, gets you well over the 200 grand in 10 years at a very low LVR. So we are buying a property every second year with 600K. And the logic with that as well is 600 grand will give you a $1.7 million commercial asset. So it's a better quality investment. You don't keep buying little sub-$1 million things. You're just going to end up with a portfolio full of junk. And there is good deals in that range, but if you want an A-class portfolio, you go to the slightly higher price point. So by the third year, he added that 1.7 mil portfolio property to it. And obviously, it's the same yield we've assumed. Now, in this model, I've also assumed 3.5% rental increases because they're scheduled. So we're not looking at capital growth. We're just looking at rent increase and accumulating a $1.7 million asset every second year. So by year two, you purchase, year three rather, you got an 85 grand passive income. By year four, it's 88 grand because you've just had that 3.5% increase. By year five, it's time to buy another 1.7 mil asset. So that, with the same 70% debt, same interest rate, 6.25% taken out of it, you're now up to 136. Year six, you don't do anything. That 136 turns to 141 because of the increase. Year seven, we're back to buying a property. Now, same thing, 1.7 mil. We're up to $196,000 year one. Your total portfolio value right now is sitting at 7.6 mil, and you've got 4.6 mil debt. The rest is the cash you're injecting. So by year 10, you're looking at a $10.6 million portfolio. You've got basically a 55% LVR on the asset, and you're sitting at $263,000 net income, and that's on the 6.25 cap rate. Let's assume, wishful thinking, the interest rates go back to, say, 4.5. That same 263 grand income will be 340. So interest rates play a major impact on this. But the way I look at that portfolio is it's low LVR. So you'll be able to refinance that at 55% debt, even on a lease stock basis almost, even if you've got no income, even if bank regulations are tighter, if interest rates are higher, you're safe. Like this would stand the test of time. The guys that might go, let's take that $5 million in equity and just leverage it up to a $20 million portfolio and it's negatively geared, you're not retiring on that. You need to keep working, and this is the buyer's agent industry. All those guys with those big portfolios, if they didn't have their business behind them, their portfolio is basically at risk of getting refinanced and called in a lot of the times. And there's a couple out there that have low debt, and they're probably the smarter ones, but their portfolios are not as impressive to the media because everyone likes talking big numbers.
How big is the portfolio? So that sounds really boring to me, and that probably sounds like the best sort of strategy when it comes to property investing. So it's assuming time.
Yeah.
You know, you can't be in a rush with these type of things. Is it also assuming the fact that he's still working, i.e. he's still running around the park?
Yeah.
And the bank's happy to lend him money?
Well, the big assumption here is that 300 grand savings each year. So not everyone can do that. So if you can do 150 a year, then you just halve those numbers. You know, you'll in 10 years have a portfolio half as big with half the income.
Yeah.
So it's still not a bad result. Like, even, you've used professional help. Your portfolio's negatively geared 50K of a similar value. We would, if we were in your position, have the same portfolio with about 130,000 passive income. So you don't need the income because you've got 20 different businesses. But if you were literally trying to get out of it, you would need this portfolio over your one any day of the week.
And this is a matter of timing, right?
Yeah.
So, and this particular portfolio here wouldn't take a lot to transition it into positive, right? Yeah, it needs some dough and stuff, but I don't.
You could do it. You just got to pay the capital gains, and there's a strategy of not doing it all at once because you got to do it.
Put it over financial years, and
you could slowly do it quite easily. And you might keep half your resis too. That's what I've done.
A lot of the stuff in here is pretty good. One of them's like a unit block, in Queensland. There's all the Queensland stuff's done well.
Yeah.
Just sit around and watch it grow in value. And the rent's going up as well. Even today I just saw some new leases come in on, and the only reason why this is so in negative cash flows because we refinanced 4 of the properties in it to 80%. Probably a year or so ago.
Yeah.
And at the highest interest rates there's been in
True.
a long time. So if we didn't do that, it'd be positive to some margin. But it's capital we've deployed elsewhere into other assets, and that should be working. But so that's a tangible example. Thanks for sharing that. We'll get it onto the video so everyone can check it out. But my summary of all this is that boring is good, predictable is good.
Yeah.
Slow is fast. It can be for many people. Don't get caught up in the noise that you see all over social media. And you're in the business of, being a buyer's agent, right? I know you guys do a lot of resi stuff, right? And a lot of people forget that. You're still highly involved in on the resi side of things. But just be careful about what you hear and see and the realities of that.
Yeah.
I'm sure you can give a more considered view to it all if people are working with you.
Yeah, and like we keep saying, you still got to start in resi. Like this guy had a good income. He had a couple of resis behind him, but he was generally worried. Like, I'm not gonna be able to retire where I'm at. And
particularly footy players, right? Any given day they could end up, not playing anymore.
And imagine you're a footy player and you've got 200 grand passive. Like, you're not going to have to take that job that you don't want to. Like, you're straight into...
Back on the building site, lugging around bricks. It happens a lot.
Getting a trade or doing a late uni
that.
degree in your late 30s. Like, you might just take a passion job all of a sudden, or what do they do?
Go get a job with a fund manager. Raising FUM is always a great one for sports players. They do it well. But not to I know a lot of guys like that. But hey, we've got time for a couple of questions, Scott. The burning questions, which our listeners really seem to like. I think we've had a similar one to this, but it seems to be connecting in with this podcast. How much money do you need to start investing with Rethink Investing?
Look, 80 to 100 grand for residential and about 200 for commercial these days.
But you're not getting a top-line asset of that, right?
But you're basically buying a high-quality strata type asset. Everyone knows the types of houses you're going to get for residential. We tend to go, our strategy is generally capital cities or major regional centres, but we like relatively new properties. And when I say relatively new, it might be 20 years old or 10. We're not the type of buyer's agent that will go buy, one of those old 2-story, like, fibro-looking things, because they might have a better yield day one, but this is the beauty of being heavily invested in commercial. We always think net yields. All the residential guys showing those old timber things are not going to put the correct maintenance in there per annum. And then you've got to replace the thing at some point because it's not going to be there for the next 100 years. And to build a house right now, that is a cost that needs to be factored into your spreadsheets for whatever you're doing with your investment. So when you buy relatively new, that house is good for 30, 40 years. And that will increase your net income, get better tenants, make it easier to lease. It's just going to smooth the period of holding properties long term. So commercial, you're generally looking at good quality strata units, and people say, "Oh, I'd want freehold." With commercial, what's that extra land on the side going to be beneficial for you unless you're developing it? Like, it's the net lettable area of the building, which is where the value of the rent comes from. So strata can be good as long as it's a well-managed strata. There's generally no lifts. There's no, it's just a strata to manage the building insurance and common areas. Like, there's not much in the strata for a warehouse complex or, a single layer of offices and stuff like that. So.
Well, there's heaps of other questions, but we'll leave them for next time. I enjoyed the chat, Scott. Yeah, it's always interesting getting together.
You too. Yeah, good to talk about your journey with the portfolio. And
yeah. I'd say it's like, I'd score me probably 6 out of 10, as a property investor. Like, I could have done a lot better than what I did, but and I haven't stopped, by the way. It's certainly.
Will you stop?
Nah.
What's the plan? What's the next plan for the
more
SPI
commercial?
Show?
More commercial.
Yeah.
Commercial in there just to balance it out. But personally, it'd be a lot more commercial.
Do you have a price point that you'd like to
I'd just like to fix that negative 50K. And but you think in a couple of years' time, if those resi rents keep going up, that'll ameliorate it to some point. But I'm going to have to inject something. Try and fix everything.
Yeah.
But I'd like to quickly. I'll probably sell 2 more properties inside of it. Okay. It's in a structure that doesn't really work for us.
Yep.
And whether we deploy that dough in a commercial will probably be what we do. That'll fix it pretty quickly.
Makes
but
sense.
It's not like a big issue, but it's just it'd be good to iron it out.
Yeah.
But
treat it like all your other businesses. If it's not making money, then you've got to fix that business.
You got
close
to,
it up.
Yeah, for sure, absolutely. But that's Inside Commercial Property with Rethink Investing. Scott O'Neill. You've got a fancy title these days. Was it founder and
no,
was it?
Just CEO of the Rethink Group.
Okay, Rethink Group.
And they say add founder because there's a lot of CEOs that haven't founded businesses. It's more of a corporate thing. So that's why, I don't like saying that word, but
founder.
It's more.
Is it good to be a founder or a flounder? It's sort of typically what happens, but it's tough to start businesses.
Flounder.
Yeah. No, you're doing well. It's good to see, and no doubt you'll have something else. I know you've got many different. We've spoken about things like solar and whatnot, so we'll have to get an update on that at some point. And how you going out in New Zealand? Because we're a lot of Kiwi listeners, and shout out to all our Kiwi listeners as well.
Yeah. No, we're still loving New Zealand. It's just the deal. Like, because I'm an investor at heart, and that's probably one of the reasons we've succeeded in business. Like, I'm not just doing it. Like, I'm doing it because of the deals, almost. Like, I love seeing them and vet them and reject them. And the deals in NZ are simply better than Australia at the moment. So I'm just like, wow, I like this. I like the numbers.
Well, we're going to put you to the test at some point soon, I think, and let's see what you can do for us at Smart Property.
Maybe an NZ property or...
Maybe, I don't know.
Lending's tougher.
Lending's tough out there. I think there's still plenty to buy out here, but...
I agree. Yeah,
there's going to be a lot of oversight on your next purchase for us, so...
Sounds good. We'll fix the problem. That's
well, it's not a problem. It's an opportunity.
It's an easy opportunity.
Yeah, it's only a problem because I'm sort of saying it's not really a problem, but it'd be nice to just have that as something which you could just forget about. Just park it and leave it and forget about it and look back at it in 10 or 20 years and go, oh, God, who would have thought, you know? Anyway, thanks for tuning in, everyone. We'll see you next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.